There's a huge amount of mystery about economics. So as David said, I'm actually quite optimistic about the economy. But what I want to do is really try to explain to you why you should disbelieve almost everything you read about economics and make your own minds up. I just want to give you a toolkit to help you do that, because it's a curious fact that, I worked out the other day, this is, because I started work in 1968, this is my 5th recession and 7th banking crisis. So other than the fact that obviously people survive these, I would tend to say that, recessions really aren't what they used to be. You're all making a fuss about this current one, but it was nothing like the 70s. And in terms of, if you actually look at the statistics, bankruptcies are far lower than they even were in the good times. Unemployment, although it is high, is nothing like as high as was predicted. There are lots of things about this recession which have not turned out anything like as badly as previous ones. So I also wonder, well, why are we making such a meal of it? And one of the reasons, I think, is that because we had such a long period from 1993 basically right through to 2008, 15 years or so, of essentially uninterrupted growth. A whole generation of people grew up who'd never seen a downturn. Basically, nobody under 35 or even 40 in their working lives had seen a downturn. And therefore, when it came, they were kind of rabbits in the headlights, didn't know how to react, and made a bit of a meal of it. But now that the economy is recovering, equally, not having seen a recovery, they don't know how that'll happen. And so they somehow expect that one day there'll be fairy dust sprinkled on the economy, and it'll all blossom and it'll all be lovely again. But of course the reality is it's not. It's messy and it's troublesome and you don't know it's happening and everything else. So I think there's a lot more uncertainty around than there ought to be. And if, as I say, my age, where recessions were a fact of life, you just got used to them. Whenever there was a good time, you think, oh, well, I better enjoy it because it won't last. There'll be another disaster around the corner. Anyway, coming to the economy, I wanted to sort of just set your mind at rest about economic growth and debt and the Eurozone, and then flag one or two things you should be worrying about. The first thing about economic growth, we are obsessed by it in this country, and every quarter the figures come out and written about, analysed and so on, and milked for everything they're worth. The one thing you need to know about economic growth statistics is they are always wrong. Always. So don't bother even reading them, they're always wrong. And they come out quarterly, and they're always wrong because of two reasons. One, they're based on surveys, not on actual facts. So they're based on people's opinions. And obviously, if the mood is bearish, then you tend to get an exaggerated downside effect. And if everybody's feeling optimistic, you get an exaggerated upturn. So that's the first thing. The second thing is, because they're on surveys, they don't actually capture the growing companies in the country. That most of the growth comes from relatively small, fast expanding businesses. It doesn't come from the big giants of the world. They basically just, a flat line. They're civil servants with share options, basically. So the surveys don't track the dynamic element of the economy. So they don't actually tell you what's happening. And the other factor, of course, is that a third of the economy is public sector. It's national health service, it's education, where there isn't any growth, but they impute a figure for it. They make up a figure. They work on the basis that more money means more growth, which is not normally how it works out. So it's always wrong. And it's so wrong, in fact, that they did a study of these quarterly growth figures over 30 years, from 1976 through to 2008. And they found in that time there were, I think, 31 quarters where the first cut of the growth figure was negative. So it was a minus. It was a minus 0.6 or whatever it might be. And they found the average upward revision of that when the real data came through was 0.9%. So in other words, absolutely dwarfing it. Now, 0.9% a quarter is equivalent of 3.6% a year. I mean, it's a colossal revision. So it just shows how wrong those figures are, and how you basically just make up your own minds, don't believe what's in the paper. They're wrong because of the surveys, and it's only when the tax receipts basically come in 2 or 3 years later for corporation tax, VAT, income tax, and customs and excise that you could get a real handle on what's happening on the economy. And so that's why they're subsequently revised. So that's the first thing. The second thing I'd say is that it's beware. We're talking in terms of growth of a very small number on top of a very large one. Minute numbers, which actually you can't really measure. So, to give you an example, in any year, all the output of the economy is produced in 250 working days a year. In other words, the year minus weekends and the odd bank holiday gives you 250 days. So that's when you produce the entire output of the economy, theoretically. Okay, so that means 1% of economic growth is produced in 2.5 days. 1% of 250 is 2.5 days, or 20 hours. Okay, which means that 0.1%, which is the kind of figures we keep agonizing over, you're actually looking about 2 hours production. 2 hours production in the entire quarter. So, the next time somebody bangs on about worrying about a double dip economy, just tell them to work through lunchtime. They'll have solved the problem. You can't possibly measure an economy as big as ours, or as big as anybody's, with that degree of accuracy, and yet we pretend we do. The third thing is beware the flaw of averages, which is that, we all who are parents have 1.8 children, according to the statistics. That's the average family size in the UK is 1.8 children. Because none of us have 1.8 children. We may have none, 1, 2, 3, whatever the number is. And yet we happily say about the economy that it's growing at, 1.8% or 1.2% or whatever it might be. And the reality is, of course, it isn't. There are bits of it that are declining at 10% or 5%, and there are bits of it that are growing at 5 or 10%. And the trick, of course, is to be in one of the growing bits. And the difficulty that you've experienced over the last couple of years is that the real decline in the economy has been in banking and finance, obviously, and in construction and housing. And the drop in housing starts from 200 to 100,000 is worth 1% on the growth rate a year. But the point is that if you've got that kind of headwind, as it were, on depressed construction and depressed banking, then the rest of the economy has to be doing quite well to get you to 1%. And the reality is that a lot of medium-sized businesses in the non-financial sector have been doing okay. They haven't been shooting the lights out, but they've been doing okay up and down the country. Much better than you would believe from reading in the paper. And I suppose the final thing is that people go on about this recession being the worst since the 1930s. And they do this on the basis that we have not yet recovered to the level of output that we were experiencing in 2007, 2008. It's taken longer to get back to that level, and we still haven't got back to that level, than it did in the 1930s. Therefore, this is the worst recession. That's the intellectual basis for it. And yet, at the same time, people say, well, the boom leading up to 2007 was entirely driven by debt and equity withdrawal and all these things. So it was unsustainable. It was frothy, it was a bubble. The 2007, it was an unsustainable peak. And then at the same time, we're beating ourselves up for not getting back to that unsustainable peak. It doesn't make sense. You can't have it both ways. We were either, unsustainably high then, or we were, if we were unsustainably high then, why are we worried that we haven't got back to that unsustainably high level? And if you remove from the statistics, if you like, the effect of debt and the bubble effect on the economy, and get a trend growth rate without the unsustainable bit, you actually find that we're back on that track now already. But the trouble is that implies a growth rate, a long-term growth rate for the economy of about 1 3/4 to 2%, rather than the 2 3/4 to 3% that we were experiencing before. So you need probably to get used to the idea that normal is actually going to be a lower growth rate than we've had in the past. But this is actually getting more solid now. And of course, as finance and housing are snapping back, getting better, then the economy as a whole, confidence is improving, and that, of course, is the big sort of fuel that should give what we have that much more momentum. So you don't really have to worry about the growth rates. Ignore them. Just make your own minds up about that. Make sure you're in one of the good bits. And I think housing is about to become one of the better bits. The second thing actually, just as an aside on that, the only economic growth measure that makes any sense is value added per hour. In other words, how much wealth is created in 1 hour's work in the economy. Growth rates themselves don't really count because they're just volume numbers. They're not efficiency numbers, as it were. But if you take value added per hour as the measure, you find that the French and the Americans are exactly the same in terms of efficiency, which is something that upsets the Americans no end, but it's true. And then you say, well, how on earth can the Americans have, twice the standard of living or spend twice as much as the French? Well, the answer is basically long lunches, long holidays, and early retirement. That the French actually take their wealth in terms of long lunches, 5 or 6 weeks holiday a year, and retiring at 60, whereas the Americans don't. And so that's the difference. In terms of economic efficiency, the two countries actually run about the same level, which is an astonishing thought, actually, not at all what you'd believe. The next big thing is debt. The government particularly bangs on about the levels of debt in the economy. Now, clearly there have been higher levels of personal indebtedness, and there still are. And I'm not saying that is a good thing. But there's a perception that when you get to 90% of debt in the economy, the whole place seizes up, and growth is a thing of the past, and the economy can't function. And this is what the government peddles, what Osborne peddles, and it's also what is born of a theory produced by a guy called Ken Rogoff, an American economist, and it sort of gained huge credibility. Until a couple of months back, when some young academics went through Rogoff's book and found he'd added the sums up wrong. And in fact, that his arguments do not support this 90% rule at all. But it hasn't actually destabilized it. But in fact, he got the maths wrong, which tells you all you need to know about modern economists, really. Anyway, it also doesn't actually fit the facts of this country, where we have, for most of the last 200 years, operated at massively higher levels of debt than we currently experience. I mean, at the moment, debt to GDP ratio is about 80%. It'll probably run up to about 90% by the time of the election. 90% of GDP. But throughout the last, if you go back to 1815, which you have to take my word for it, as even I am not that old. But at the end of the Napoleonic War, the debt to GDP ratio in this country was 250%. So it was, 2.5 times what it is now. And throughout the 19th century, the Victorian era, when we were, the world's foremost economic power, it was never below 100%. It only got down to that level around about 1913. Then the First World War, Depression, Second World War, whacked it up to 250% again by 1945. And it only then gradually declined, largely through inflation, quite honestly, in the 70s. And it got down to about the 40s at the end of the 80s. So for most of the time, we've had much higher debt levels. And they have not inhibited our economic growth. I mean, the 30s are a case in point. The 1930s have a bad press in terms of the perception we have of grainy figures and soup kitchens and so on. But that was much more the 20s. Economic growth in the 1930s, from 1932 onwards to 39, averaged between 3.5% and 4%. And largely because we were building 300,000 houses a year, which is why, as opposed to the 100,000 we struggle to build now. Every town in the country which has got acres of 30s suburbs were built in, the 1930s. They're still there. 400,000 houses a year. I mean, it's an astonishing thought when you think what we struggle to do now. But the debt ratio when we were doing that was never below 140%. So, even in the 1930s, which were not the most favorable of conditions, the economy actually flourished, largely because of some new industries like electronics and motors and radios and so on, but largely through house building. So there we are. You don't have to worry about the debt ratio. Don't worry about debts. As long as people are confident, then you don't have to worry. It only becomes a problem when people lose confidence. So there, you don't have to worry about growth. You don't have to worry about debt. You're feeling better already, aren't you, in spite of the weather? The other thing is the euro. I mean, why we bang on about the euro in this country so much is beyond me. But there we are. We do. But the great fear has been that the euro will break up. But nobody actually says why we should be scared that the euro breaks up, if it were going to. And if I ask you how many currency unions there have been in the world that have broken up since 1945, I mean, I don't suppose you've got a clue, but you might say 1, or you might say 3, or you might say 5, and there'd be guesses. The actual number of currency unions that's broken up in the world since 1945 is 70, 70. And you didn't notice any of them, did you? So why are you so worried about the euro? A typical one, I mean, most currency unions, when they break up, are because political structures change. So the obvious one would be the Soviet Union 20 years ago, when it collapsed into Russia and Ukraine and Georgia and all those stands and all that sort of stuff. Now, when that was happening, we didn't sort of agonize and say, oh my word, it's the end of the ruble single currency. What will become of us? We were worried about what might happen, but nobody gave a moment's thought to the currency issues. Or similarly with Yugoslavia, in the war in the 90s, when it broke into Croatia and Serbia and so on. There was a lot of coverage of the horrors that went on in its war, but nobody was worried about it being the end of the dinar single currency union. It adjusted perfectly normally. The Croatian places just backed the whole currency, and life went on. And there's very little reason why that wouldn't happen were the euro to break up. And of course, people say, well, think of the disruption. Well, we're actually having the disruption now in terms of the austerity and the banking balkanization and the uncertainty. We're going through all the pain of breakup at the moment without actually getting any of the benefits. Now, I actually don't think it will break up. I think it's too worth Germany's while. But I mean, the way to think of the euro is to think of it as the Deutschmark with disreputable friends, basically. Hardworking Germans and partying Southern Europeans. And as long as the Germans are prepared to pay for the party, then life will go on. And it's in their interest, because without the euro, the Deutschmark would be valued at 20 or 30% more. And so German exports would be far less competitive in the world. So that drag of the Southern Europeans is keeping German exports much cheaper than they ought to be, and therefore benefiting them hugely and maintaining their position as the world's biggest exporter. And when it comes to worrying about what's going to happen to Greece or whatever, are they going to default or are they going to recover? The Greek economy doesn't matter to anybody apart from the Greeks. It's tiny. It's about 3% of the Eurozone. I mean, it's like Scotland with better weather. It's of no consequence at all, I can say that because I come from Aberdeen. Can't go back there now, but I can come from there. But really, it is actually quite bizarre that we worry about Greece leaving the Eurozone. The idea of Scotland leaving the UK, which is a far bigger economic shock, basically doesn't register south of the border. Big deal up there, but the rest of England is completely disengaged by the thought, or the rest of the UK rather, is sort of disengaged by it. Anyway, that's another issue. So you don't, in my view, have to worry about the Eurozone. I mean, most of the problems seem to be manageable now, and it is beginning to recover. And so and we've gone through most of the disruption. There will be other shocks, but I don't think it's going to derail the UK economy. And it still remains the source of half our exports, so the sign of it getting better there is obviously going to benefit the UK. So you don't have to worry about growth, you don't have to worry about debt, you don't have to worry about the Eurozone. You see, life's wonderful. Life's a beach, isn't it? Things you perhaps do have to concern yourself about. One is China, and that's a long way from the housing market, so I won't dwell on it. But China has been a great fuel of demand in the world, and there is a great question about whether, well, there are two questions. One is this the decade or the century of the Chinese? or is China just going to go pear-shaped again? And there's a lot of talk that here we are in 2013, and this is clearly the century of the Chinese. Just look at the way they're going. My only word of warning on this would be if you go back 100 years to 1913, when there were two major powers in the world, which was Britain and Germany, and there was a kind of upstart across the Atlantic, which was beginning to show signs of life and might rise to challenge these two countries. Now that upstart was Argentina, not the United States. In 1913, most people thought the next big power in the world was going to be Argentina. Based on the same argument we're using for the Chinese. It was growing at a colossal rate, it had huge resources, it had workforce and so on. It was opening up. And it didn't quite work for Argentina. The football's better, but the economy isn't. And therefore, while I'm not saying that China will not continue to grow, it's a very bad idea to take 20 years of data points and assume they're going to carry on for indefinitely into the future. And the problem with China is that it's essentially economies, very few economies actually make it to prosperity. Many try, most fail. And the reason is that the two kinds of economy, there are the inclusive economies and there are the extractive economies. An inclusive economy is basically one where everybody gets a fair crack of the whip, where the institutions are honest, corruption is limited, and you've got a rule of law. And the extractive economies are essentially those where the system is rigged so the elite take most of the benefits. And China is one of the exclusive ones where the elite take most of the benefits. And the rule of law is arbitrary, to say the least. And it's very interesting to know whether it would be able to carry on its growth rate and handle the adjustments that are going to be needed, because clearly the current elite are not going to want to lose power and influence. So there are many questions about whether China can actually carry on growing at the rate that we assume it will. And there's nothing special about 12% growth rates that it's been doing, because Japan did that for a decade after the war. Then it dropped to 6, then it dropped to 3, then it dropped to near enough 0. So a lot of the growth has been catching up, and they're actually only now coming to the hard part, which is building a new economy. So don't necessarily waste your time learning Mandarin. Wait for them to learn English. It's a hell of a lot easier. Closer to home, I think the next big issue is our recovery and how sustainable is it. Now, clearly, what we've got at the moment is, as I said earlier, the non-financial sector has been doing okay. And the difference over the last 6 months or so has been that the banks are gradually getting their act together and lending is beginning to flow through the economy again. And that's beginning to fuel things, particularly housing, with the special efforts that have been made to get the housing market going. And so, that looks okay. That's fine. The difficulty is, for the recovery to be sustainable, you then need other things to kick in. And the main thing you need to kick in is for companies to start investing in new plant and equipment and everything else and creating new jobs. And that gives the economy real momentum. Because without that, you can't just live by consumer spending alone. You need something, with a bit more bottom to it. And investment spending has been very depressed for several years. Now, the conventional argument is, well, you can't blame business, can you? Look at the economic conditions. Who would invest? They'll sit on their hands and wait until they're more confident things are going to get better. And that's what you would normally expect. And therefore, as things get better, you would expect them to start spending a bit more. And if they do, then we don't have a problem. The difficulty is, or the danger is, something that an economist called Andrew Smithers has just written a book about, but he's been banging on about it for some time. And he argues that the new structure of pay in companies, where executives get massive bonuses for delivering short-term results, mitigates against them taking the long-term investment decisions the country needs. And he says, and he's one of these people who actually, get stuck into the data. He says that investment in the UK, or the willingness to invest, has been in decline for about 12 years. So long before the 2007-8 crash. So investment was declining before then, he says, in this country and in the United States, but not in Germany or France or Japan. And he attributes this to the fact that it's in the UK and in the US that the bonus culture has really taken root, whereas in the other countries it hasn't. And what he says is that we will not get the investment we need because it's against the personal interests of the executives who are rewarded on 18 months, 2 years time horizons. Why would they take the chance? Now, if that's true, then that is potentially a drag on our ability to maintain the momentum of the recovery. It'll carry on at the lower levels, but it's obviously finite because of all the coming up against the constraints of consumer spending and borrowing and everything else. So that is a significant worry, which most people cope with by ignoring, which is normally the best thing. If you can't solve the problem, stick your head under the sand. It normally works. So that's the real issue about the recovery. But other than that, I'm really quite confident. There are clearly issues about housing supply, and we need to build massively more houses. And the bizarre thing I find about this government is that it cuts $1 billion off its grants to housing associations and ends up spending $3 billion more on housing benefits to put people into rented accommodation. We spend $23 billion a year on housing benefit now, and if a fraction of that was put into social housing, then we might actually get a supply increased. But that's another issue. But there are clearly problems there. But essentially, I think that this recession has got legs. It's going to last. It's beginning. Other countries are picking up too. So, it's been long enough. Also, people get bored with recessions. You get fed up with it. You just think, instead of waiting for things to get better, you think, let's just get on with it. And once you do get on with it, you find it's not so bad. And things get better. So there's that. That then takes us directly to your part of the world, which is what's going to happen to interest rates and inflation. Now, the official line is that interest rates are going to stay near enough zero. Well, the official rate, obviously the lending rates are a bit higher than that, is going to stay near enough zero until unemployment drops below 7%, and that's deemed to be at least a couple of years. I have mixed feelings on this. Somebody said to me the other day that if you take the interest rate in the economy, and for the last 200 years, basically, since records began, we're actually at the average level of interest rates. The average level of interest rates in the economy over 200 years has been of the order of about 2.5% to 3%. And therefore, it's only really since the war, or in the 70s and 80s, where we got into this massive fluctuations of interest rates up and down and 15% and so on. And so that argument is we're back on long-term trend. So don't expect any movement. I personally, being a kind of child of the 1970s when inflation hit 26%, and I remember my mortgage rate going to 17%. Which with a 3 times mortgage meant 52% of my income, gross income, was going on mortgage payments. I think you're all a child of your own history. So I personally think we're going to get more inflation, and we're going to get more interest rates will rise to compensate for it. I also find it very difficult to believe that all this quantitative easing, all this money pumped into the economy, can actually be withdrawn without causing inflation, because essentially the government owns about a third of the total national debt. It's 340 billion of debt that the government's bought through quantitative easing. Now, my view is they could just forget about it and cancel it, because it's the Bank of England owing it to the Treasury, and they're all part of the same thing. So why don't they just cancel it? And that would cut the debt to GDP ratio down to 40 as well. There we are, solve George Osborne's problems. But they haven't actually got to that point yet. But I think that I would tend to go with the Bank of England and its view that interest rates are going to stay low for the next 18 months to 2 years. I think the economy will recover a bit faster than they expect, and I think unemployment will probably come down a bit faster than they expect. But I think they'll be absolutely terrified about nipping it in the bud, and particularly with an election coming up. They're going to get no favors for damaging confidence by starting hiking interest rates up. So I think they're going to wait, in a way, too long. I think that they will they'll leave interest rates low, basically through to the election, and by which time there might be a bit more inflation in the economy than they want. But they'll change the definition, and fudge that for a little while. Then after the economy, the next government, I think, might be a bit more worried about, the inflation will be there then, and I suspect they will perhaps begin to move interest rates up again. I don't necessarily see that as a bad thing in the long term. I think the economy works much better when you have a normal rate of interest. I think it'll probably take the feeling of uncertainty and strange times out of things when we have a more normal rate of interest. But getting there, of course, is going to be difficult with all the negative equity and so on that's out there. But I think the message for the next couple of years, I think, for you is set fair, that these schemes will continue, that interest rates will be fairly low, that the money will continue to flow, and that the housing market supply will respond, and I think things will go. The talk about the bubble, the big housing bubble born by Help to Buy and so on, I find complete nonsense. I mean, going back to my floor of averages, a national housing price rise figure is ridiculous when you have London and you've got the rest of the economy, the Russian oligarchs and the middle-aged sheikhs are not using the Help to Buy scheme to shop in Kensington and Chelsea. And the fact is, you can buy a house in St John's Wood or a street in Sunderland for the same money. You don't have the idea of having one national house figure is a nonsense. And the reality is, in most of the country, house prices have moved, if they've moved at all, very modestly. And so the idea of talking of a bubble at this stage is ridiculous. And also, even now, I think in August, we had something like 50,000 new mortgages put forth. The average number of monthly mortgages from 1992 through 2007 was 100,000. So, even in August, we had half the long-term average of mortgages, albeit some of those were secondary mortgages and so on. But there's still an awful lot of demand not being met out there. So I think that we can go an awfully long way before we have to start panicking about bubbles and so on and so forth. So I better slow down. One final thing I would warn you about. There's always the unforeseen things that get you. The one thing I would worry about is not the economy or interest rates or any of that. The one thing I would ask you to worry about is solicitors, because there are, according to the SRA, between 1,200 and 1,500 solicitors in the UK now who are basically bankrupt. Verging on the edge of being closed down for being insolvent and liable any day now not to get any PI insurance and therefore be forced to close. So be careful about with whom you deal, because if a solicitor goes bust halfway through a conveyance, then all the files get impounded and contacts cannot be exchanged or anything else. So I think that actually seems to me to be the biggest hazard that the housing market faces in the short term. Nothing to do with the economy at all. Thank you very much.